All right. Good afternoon. Thank you for hopping on here. I'm going to get going in just a minute. I'm Drew with Central Lending. Using this system called StreamYard. So basically, there's like a virtual stage on the side, and you can like pull people to the stage, take them away from the stage. There's all these different platforms. So it goes to Facebook, Instagram, YouTube. You can go from tab to tab. So pretty interesting. I haven't done this before on this particular platform, so I just hope I don't fumble around too badly. But I'm excited to get to it. So I'm going to get going in about a minute. I'm going to get going in about a minute. Just let a few people trickle in. Hope you guys are doing well. If you have any questions or any comments, please just chime in, or at least let me know you're there. At least say hello, Also, if you see me look to the side, it's because I have a second monitor on the side, and it's so I can read the chats from the different platforms. So it looks like there's 20 or so you've trickled in from different platforms. I also can't necessarily see all the chat on all the platforms if you're not in the StreamYard link itself. So anyway, we're going to get going. All right. So we're here to talk about being halfway through the year. How about that? How crazy is that? So I guess it's June 11th already. So 3 more weeks, and then we are halfway through the year. So kind of interesting. Hello, Darren. Hello, Mark. Hello, Maxine. Hello, Joel. And if I can't see you from a different, actually, you know what? I'm gonna take a risk here. I'm gonna toggle this button, and now the comments are showing on the slide. Isn't that cool? Hey, Dan, how you doing? All right. So we're talking a little bit about what we've been up to first half of the year, some headlines, market update, kind of where we are going with pricing on our credit box and what we offer to the public, the market, and then a bit of a Q&A, but of course, questions can come in at any time. So, this is kind of what we've been up to for the first half of the year. So, and we're not half of the way through the year yet, right? We still got 3 more weeks to go. So, but as of June 8th, 264 loans funded, almost $60 million of originations. We did fund a $1.74 million loan. I'm very curious to see when that one pays off. Hopefully it pays off soon. And we funded 208 unique borrowers. But there can be situations where you have 2 or 3 or 4 guarantors on one loan. And then we've worked with a lot of brokers as well. Hello, Joseph. How you doing? Cape Coral. All right. Local. Awesome. So you can see our concentration of where our portfolio is and where our activity is. So we have a lot in the Southeast and a lot in the Midwest. Those are markets we understand. Those are markets we believe in. The cost of construction, we sort of get it. We've done our own deals, like we've lived there. So these are the markets we really understand well that we can compete in. Our average borrower, despite what they will tell you, our average borrower pays off in about 10.5 months. So for all you guys that tell us you're going to pay us off in 3 or 4 months, I'm here to tell you that across all the data, the average payoff takes more than 10 months. So kind of interesting. So just be careful if you're agreeing to that 6-month term that you have crews ready to start the week after closing. Another cool thing I did is I was trying to think of what slides can I pull that would be interesting. So I pulled a spreadsheet of over 100 payoffs this year. So I had Claude search through 100 payoffs this year, And then I had it search on Zillow to see if we could find sale prices. And then I looked at who has done the best in their sale price versus the ARV that we thought they would get at Central Lending. Now, keep in mind, I'm going to anecdote this properly. The ARV that we project is based on the rehab budget that we have. So if they don't tell us they're doing a rehab, or if they say they're doing a 5 or 10K rehab, they do a 50K rehab, right? It's going to be different than we project. But with that little anecdote in mind, I wanted to highlight our superstars here. So this deal, they outperformed ARV by 44%. That's huge, almost 90K. This deal, they outperformed ARV by 22%. This deal in Florida, they outperformed ARV by 21%. Galloway Road, I know who this is. I believe that's Alvaro. He outperformed ARV by 60K, 18%. And then this deal in Philadelphia outperformed ARV by $40,000, 15%. There's a few non-disclosure states in here that I couldn't tell what the sale price was, and I didn't bother to ask the borrower. But this is just from what was easily available. So, but this is out of 100 payoffs, right? So this is the outliers. We funded 70 loans in April. And we are using a lot. We are basically refining the way we work to try and be a lot more efficient. And I'm going to get into more of that in a moment here. But before I do that, I want to get into some headlines that we've seen. So we did our second annual investor summit here in Lakeland, Florida. So thank you very much for those of you that could attend. This year, we decided to invite our borrowers and broker network as well as our investor network. So that was cool to kind of see both sides of the capital come together from their unique perspectives. This is something that we are changing at Central Lending. Obviously, you guys are seeing the headlines. We got the OpenAI, IPO. We've got the Anthropic IPO. We've got the SpaceX IPO. We've got big tech just running really fast this year, and we're trying to find our way in this world and just kind of figure out what does that tech mean for us. And we're sort of in a middle ground where we don't want to be a company that has the machines making all the decisions, but on the other hand, we don't want to be using pen and paper for everything, because if we're too inefficient, then we are going to have to charge higher costs to the market to stay profitable, to stay in business, and then that'll make our cost of goods, unreasonable for the market. So there's like a middle ground where we need a human in the loop, is what it's called. We need a human sort of reviewing the work of these machines and systems, but we have to be on the cutting edge, not necessarily cutting edge. We have to be near the front of technology so that we can embrace it and use it effectively without misusing it. So there's a lot of really cool things that we're doing with Claude skills. And you can take your pick, right? You could use Claude, you could use OpenAI, you could use Gemini. They're all kind of doing the same thing within 5%, in my opinion. So it's not really that important which system you use. It's more important that your whole team uses the same system the same way. And the skill is really, how do you tie that system into your own personal workflows? And how do you integrate that system into your work life? So the details are in the integration. That's where the secret sauce is made. It's not, can I use GPT 5.5 versus Opus 4.8? It's 6 and a half a dozen the other. Like, it doesn't matter which model you're using. It matters how you integrate that model into your workflow. So we've been spending a lot of time on Claude. We've built a lot of skills. I'll give you a really cool skill that we have. So we have a skill that basically will take a borrower's credit report. It'll take their background check from Thomson Reuters. It'll then do a deep Google research of them. Like it'll search all over the internet who this person is, find them on LinkedIn, find them on social media, whatever. Then we will look up the mortgages they've recorded, that their entity has recorded and they've recorded personally. Then we'll pull their CoreLogic reports, and then we'll look at the track record they gave us, and we're going to dump all of that into a sponsor analyst skill. And basically the sponsor analyst skill gives us a score between 1 and 10. How risky is this person to lend to? And 10 is like auto decline. 1 through 4 is like, let's get the wire out as fast as we possibly can. And then, 5 through 9, I'm like, okay, what's going on? How can I sharpen the skill to have less edge cases? And that's just one example, right? We have another one we're working on where we are uploading all of our budgets. We're collecting all of the rehab budgets that we can get our hands on for loans we've cleared to close. Then we're trying to tie it to the zip code that budget was in, because labor prices change depending on market. Material prices, maybe not as much. Then we want to tie it to the ARV, so $1 million home isn't the same as a $600K home. And then we want to also have square feet of that project and beds and baths. And so we feel like if we can put together 500 to 1,000 of these budgets, then we can create a really, really good budget analyst skill that'll be able to look at a budget and tell us if it's feasible across 3 dimensions. So the first dimension being, are the costs reasonable in that market? The second dimension being, does this budget actually fix the house? So AI can actually look at pictures of your kitchen and tell you if it's missing appliances or not. Then it can look at your budget and tell you if there's appliances on the budget. So simple things like that. And then the third dimension being, is this budget versus the actual deal, is it penciling out as profitable? So individual costs, do they make sense? Is the house getting fixed? And then is it a profitable deal? So 3 dimensions for that skill. So just multiply that across the 50 things we do on any single loan, and you can kind of see the impact that these technologies are going to have. Okay, you could probably tell I get a little excited about technology, Anyway, let's move on to sort of a couple of something a little more noble. So every time we close a loan at Central Lending, we donate $50 to a charity, and we change our charity or a nonprofit. We change it every quarter. If you have a good nonprofit in mind, please submit it to our team. We're kind of looking for options for 3rd and 4th quarter. And then, as I said earlier, we're going to try to bring these webinars around a little more frequently. So we're sticking to a schedule. We made the schedule. We're sticking to it. Loan originations on the 2nd Thursday, capital raising on the final Thursday. So just a little bit about the market. And actually, I'm going to take a bit of a risk here. I'm going to take a bit of a risk here and see if I don't break anything. All right. Got a different. Wait a minute. All right. Stay with me. Okay, here we go. All right, so I wanted to kind of pull up some of these prediction markets. I don't know if any of you guys do any of you guys follow prediction markets, or is it just me? So what's really interesting about prediction markets is so just to explain what prediction markets are to you guys that don't know, prediction markets are where you are betting on an outcome with real money. And a lot of these markets are held overseas, but they're very efficient markets. And what happens is when people bet with their money, they tend to leave their bias, behind. When people are betting with their wallet, typically they're detached from bias, or their bias will be punished because they'll lose money, essentially. So what ends up happening is these lines get remarkably accurate. These are like the best handicapping lines you could have. So I pulled up a few prediction markets that I thought were interesting. First one being World Cup winner, of course. We got the USA at 1.7% to win. So, you know, kind of disappointed there. Favorite being Spain and France. But if you bet on the USA, you can get a 50x return on your money. Kind of interesting. Oh, this one's funny too. How rich will Elon Musk get before 2027? We got the more than 1.3 trillion is he's a favorite on that line, and 1.4 trillion he's an underdog. So the line is somewhere between 1.3 1.4 trillion. Isn't that crazy? We're gonna have a trillionaire this year with that SpaceX IPO. But anyway, something a little more relatable is these rate cuts prediction markets. So you can kind of see at the start of the year, the prediction of rate cuts was so December 31st, 3.2 rate cuts was where we had a 50-50 line. And then it went up to 3.5 rate cuts. So I don't know if you guys remember back in January, we hadn't bombed Iran, and the world was a little bit different back then. We were thinking, oh man, that GDP is going to be 4, 5, 6%. It's going to rip. We're going to get rate cuts. Like, let's go. And the prediction markets and all the analysts and all the talking heads on TV, whatever, like they were all saying, oh yeah, we'll get 2, 3, 4 rate cuts. So 3.7 was the line. And you can see over time that's come down. Then near the end of January, 3 rate cuts was the prediction. And then in the middle of March, it was 2.5. And then start of April, 2. And then you get into May, we're at 1.5. And then June, now we're somewhere between 0 and 1. So 0 rate cuts is the favorite, and 1 rate cut is in second place. So it's kind of remarkable. We've gone from like, wow, probably 3 rate cuts, maybe 2, maybe 4, to definitely not 3, definitely not 4, probably not 2, probably not 1, probably 0. So it's just kind of interesting to see how that's changed in 5.5 months. And then another prediction market is, when is the next Fed rate hike going to be? So before July of next year is where you're at 70%. But before the end of the year is only a 50-50. So kind of interesting. Let me close that. Also want to kind of just show you guys a couple of Redfins. I do look at the Redfin once in a while, look at the median prices. Austin, year over year, is feeling a bit of pain. Florida is up year over year, but it just depends where you're at. Cape Coral is down year over year. Tampa is down year over year. Lakeland down year over year. New York up 5% year over year. Pennsylvania up 5.6% year over year. Illinois up 5.6%. Ohio up 5.5% year over year. Michigan up 5.5%. And then, of course, Detroit. I hadn't pulled Detroit. Detroit's up 4% year over year. So, these Midwest supply-starved markets are kind of crushing it right now. And some of these Sunbelt, southern markets that had that massive boom after COVID are still kind of feeling like a light pullback and a supply increase. And I just wanted to share that with you guys. All right, let me get back into I'm going to get back into these regular slides. All right. I don't know how to save multiple screens at once, you know? Here we go. RTL and private lending is doing pretty well. We're you know, the industry is definitely growing. You're not getting involved in the declining industry, that is for sure. I mean, 2025 was a record year by all metrics. DSCR is getting more and more popular. And then RTL is getting more and more institutional. So it's getting more popular and it's getting more accepted as a robust asset class. And it's getting more and more attention from institutional investors. And that's having pretty interesting impact on what we do. Hey, Delrose, how you doing, bud? This is kind of interesting. This is hot off the presses. So this is this week. so this news just hit. So hard to believe that, you know, one of my competitors got acquired for $700 million, right? Isn't that crazy? And Kiavi's a big lender, reputable lender, very fintech focused. And what's interesting about Kiavi is when the way I think about Kiavi is kind of funny. Basically, when I do one loan, they do 50. That's kind of how I think about them. And then I think about what is it like to operate at that scale. But there was some pretty interesting. This is just a very interesting transaction in our space, and I think, you know, everyone's kind of following it. Everyone's kind of talking about it. But the originations volume was 7.8 billion in 2025. 250 million of revenue for this originator. 100 million of EBITDA, 40% EBITDA margin, 3 out of 4 borrowers returning, 7x on customer acquisition cost, and basically earning 3% of every dollar lent out, a little over 3%. So just very, very interesting that our space is getting, you know, it's kind of, private lending's kind of coming out of the back rooms and is not only getting attention, it's getting the attention of both institutional investors and also venture capital, right? So it'll be interesting to see kind of what comes of this transaction. Securitizations are still huge. I just mentioned a few on here: Kiavi, Fidelis. A bunch of companies are doing securitizations, and if you can connect the securitization money to your borrowers, you can deliver the lowest cost of capital. But obviously, you have to be operating at a certain level of scale to do that. And what we do at Central Lending is we actually sell a lot of our loans to aggregators that will then go out and securitize themselves. So we're not quite vertically integrated, but we are very interested and active in how this market works. Just a couple of stats. You know, I take these with a grain of salt because, you know, it's just pulling a bunch of, you don't know what the rehab budgets are on these things. So, but you're seeing a 65K gross profit per flip. You're seeing, you know, these Midwest markets do well. And I think we already went over some of the winners and losers. One of the things we're changing at Central Lending to try and drive more revenue is we are getting a little more competitive on price. But It's on a very specific type of deal. It's only on very, very competitive loans, and it's on institutional quality. It's basically on institutional quality loans. So if the loan is institutional in quality, we will compete on price, because if we can sell that loan to capital markets, or if we can get that cheap capital into this deal, then it remains profitable for us. If you're bringing us a scenario that requires more of a private solution and has to stick on our balance sheet, then we are going to charge more for those deals. So I give you guys an example. Like, if I get a fix and flip, guy has 700 credit, he's done 20 fix and flips, I can fund that deal in a week, and I can sell that loan to 15 different aggregators, right? They all want to securitize. They all want the loan. It's predictable, proven, almost boring at this point. It's just easy, right? But let's say I get a builder that wants to buy a vacant lot for $80,000, a little infill lot, and he wants to borrow $40,000 to do that. There is no lenders that really offer that. So in the first deal, in the institutional loan, I'm going to have to be 10%, maybe 1 point to win that loan. On the second deal, I could be 12% at 6 points. Isn't that interesting? So depending on which loans have a lot of capital demand for them, that's kind of what drives competition in the market and eventually drives pricing. So that's what's kind of made up our strategies. Depending on what we can do with the loan, how competitive the loan is, we will set our pricing based on that. But we are getting more aggressive on cookie cutter deals. So 9.99 is our standard rate. We're also wanting more profitable deals. So last quarter, this viability ratio was 1.2 on fix and flip and 1.25 on fix and flip. So we are wanting better deals. If we're going to give better pricing, we want better deals. If we're going to offer higher leverage, we want better deals. So we don't want a deal where it's extremely skinny on paper and the only one making money is the title company, realtor, and lender, right? So we believe that borrower profit correlates directly with loan performance. So we're going to give a little on price. We're going to try and win a little more deals on price, but those deals have to be the right type of deals. That's kind of the thesis that's the thesis of where we're headed the second half of the year. Okay. So we'll get a little more aggressive on leverage. Didn't really move leverage a whole lot, but we will get aggressive on price, but it has to be a strong deal. It has to be a very strong deal to justify that price. Here's a couple of changes we made. So we did cut our rate, but we increased origination fee for these two credit bands. We're only charging 1/8 though, so not really a big deal. We brought our base fee down 0.5%. So 1/8 of originations, not a big deal. But if you have a 740 FICO, we have no LLPAs for your origination fee. So no loan level price adjustments there. Here you can see at the top, these are the asset classes that we don't think are nearly as competitive. So multifamily, mixed use, commercial, and vacant land. There's really not a lot of capital available for those deals. So if we do choose to fund them, we're going to be charging much higher origination fees. And then builder experience. If we extend a deal to a newer builder, they get a big leverage hit, but also a big pricing hit as well to compensate for the risk. And I just want to be clear, just because you're a new builder, we still want you to have fix and flip experience, have a GC license, have a profitable deal, have some type of mitigating factor there. Hey, Gilbert. Yes, we do ground up construction, but we don't lend in California, unfortunately. But thank you for hopping on nonetheless. So this is our goal for 2026. We are looking to do 180 million in loan originations. We believe we're going to have to do somewhere between 750 and 800 closing units to get there. We believe we will end the year with around 200 million in servicing, 85 million in assets under management, and hard to believe that that we think it'll be around 2,000 construction draws this year. Now we're sort of projecting as best as we can, and these numbers were recalibrated a couple months ago, so they're not exact projections, but yeah, this is kind of where this is what our goals are. So we are going to have to ramp up for sure, and we're on a growing trajectory, and we hope our improved pricing will help with some of that, and processes, by the way. This is why we do what we do, guys. Fast, reliable funding built on transparency, driven by service, and powered by the belief that real estate investing should be accessible to everyone. So whether you're an accredited investor fueling our deals, or whether you're a new investor getting into your first fix and flip, we are bringing capital to you and providing value to the market. And here's Q&A. Yeah, here's Q&A. By the way, I'm going to show you guys how to submit a deal on our portal in just a moment here. All right. So if you want to send us a deal, let's not go to the admin panel. So we have this website, miloservicing.com, named after my dog, by the way. My dog's name's Milo. But it's white labeled so that brokers can send us deals. And that way your borrower can't like circumvent you and go directly to central lending, right? So it's white labeled. Joel Armstrong says, what this year work together? And sorry, Joel, I didn't catch that. So I want to show you guys the software we've been building and put in a sample deal. So my question was, what % of the loans you have funded in 2026 year to date have been sold on secondary market? I don't have the number in front of me, but I'm going to guess it's around 60%. I'm going to guess our capital raising team could give you the exact number. I'm going to guess it's around 60%. And I think I'm within 10% of being right. Do you have a non-disclosure for the brokers? We have a little broker agreement. I mean, please don't, we're not going to circumvent you and go to your borrower. I think we've got a good track record, and, we're not, we'd rather protect the relationship with the broker than like cut you out of like an origination fee on one deal. You know what I mean? But yes, we have like broker protection and all that kind of stuff. And interestingly enough, as a broker, you can actually register your borrower on our website, and then their account, the email that they use to set up their account, is hard coded under your email. So it's rooted under your broker account. So so the way to make sure you 100% never get circumvented is you create a broker account and add your borrowers in. And at that point, any deal they submit in the future, automatically it adds you, right? Now, if you just give the broker, this link and say, go submit a deal, there's a chance that we might not know it's attached to you or what have you. So the best way to control that is just to go into the system and enter that borrower. But I'm going to kind of show you guys how to submit a deal on Central Lending. I think there's a few brokers and borrowers here. This is sort of the originations show. But we have got fix and flip, ground up, stabilized bridge, which is no construction, and DSCR. So fix and flip is when there's improvements to the property already. So it's real estate, right? Real estate is dirt, right? Everyone knows that. But the dirt is already improved with a house. Okay. So the real estate is improved with a house, but we're improving it even further. Like we're improving that house. Okay. Ground up construction is real estate that is not improved. So you're dealing with dirt, or you're dealing with a tear down or fire damage or something where you're going to scrape the lot and basically go from unimproved real estate all the way to a completed project. Stabilized bridge is no construction. So this is where the collateral value on the closing day is stable for the entire term of the loan. So there's just one value to measure, one advance. It's a very simple loan. And then a DSCR loan is on a stabilized rental property. It's amortized typically over 30 years. And qualifying for the loan is based on the rent covering the mortgage, essentially. So I'm going to go in and show you guys a fix and flip loan. This represents about 75% of our closings. You can add an entity and a borrower here. I'm not going to do that on the screen, but I will make, wait a minute, can I make the screen bigger? Let's see. I'll make the screen a little bigger. Now you can put your deal in. And it's interesting when you're doing design on technology, even just the autofill even just the autofill of the address, you have to connect to like a Google API system where you can read all the addresses. Like there's a whole system to that, just the amount of detail that goes into it. Like users don't realize that nuance, but then when you don't have it and you have to type in your zip code, it gets kind of annoying. But when you have a drop down and it knows the address, like that's cool, right? So little features like that we had to actually build out. Now this screen is basically why we did this. I've bought a lot of third-party software on the market. I've spent so much friggin' money on third-party software over the last 5 years. And I would go to these companies that would sell software professionally. And I would say, can you build a system where my borrower can put their deal in and get their pricing, right? We live in an age of Uber Eats and Airbnb and instant gratification. Like I want this on Amazon, right? I want, I want a flashlight. So I'm gonna click 2 buttons and it's there next day. So but you try to get a loan from a hard money lender, private lender, you usually submit a form and hope someone in sales calls you back within the week, right? It's just like a terrible system. So why can't we give quick pricing to our clients? And no one would build it for me. That drove me nuts. So anyway, we've built a system where you put in your credit score, your rentals, your fix and flip exits, your ground ups, and then you get your leverage here, your interest rate, and your origination fee, and your estimated monthly payment. Also, if you want a custom loan amount, you can enter it here. Let's say you wanted to keep your payment down. Let's just say you wanted like a lower payment. You could pick a custom amount here, okay? You can also pick a 12-month loan or 18-month loan. You can see that origination fee changes just a little bit. Also, I built a feature where you can buy the rate down and the origination fee goes up. The ratio is 2 to 1, or you can pay a higher rate and have a lower origination fee. Now, let's say the credit score gets lower. You can see the fee went up and the leverages went down. And let's say the experience also goes down. Same thing, right? So you're getting lower credit, lower track record is lower leverage and higher fee. So it's dynamic to the scenario. Also, if you put in a deal that doesn't make sense, let's just say you have a 200K purchase and a 100K rehab and a 350 sale price, it's not profitable enough. And I probably need to pretty this up a little bit. Yeah, I probably need to pretty this up a little bit, but it basically tells you on the fly, like, hey man, that's not a deal. Okay. But yeah, you could choose one of these options, pick your signing date, opt in, and tell us if you are plan to occupy the property, right? We hope you don't. we do business purpose lending. We do not do any type of consumer lending here. Nothing that would be, sort of TILA protected or Dodd-Frank regulated. So we do strictly business purpose lending for real estate investors. And it doesn't mean that you can live in the house and just close in an LLC and we're going to look the other way, right? We're not that shop. There are shops that do that. It's not us. You want to tell us, so we care a lot about how a deal was acquired. So if it was an MLS listing, typically that means that, we can look at the list price, the listing history. Normally, if it's an MLS deal, we know that it's an arm's length transaction, but we also know that you're probably not getting the best deal if it's on market, right? If it's off market, then we sort of have to get into the story of how you found the deal, because we find a lot of related party transactions, which can cause a bunch of issues. If you're buying off a wholesaler, we just want to know, who is the wholesaler. We are interested in assignment fees, but we can finance assignment fees as long as they're arm's length, right? So as long as the wholesaler, the seller, the buyer, everyone's acting legitimately in their own best interest, we can finance assignment fees. Direct to seller is the best way to buy a property. And this is going to get us the most comfortable with granting our best terms. Obviously, we need to know when you're going to close. We have the ability to have the borrower go to the property and use proxy pics, essentially, which is an app that will geolocate and timestamp your photos. So if we're given just static offline photos that we can't authenticate, well, then there's a higher chance of fraud with something like that. But if we can use proxy pics to take the photos, or a third-party inspector, then we can control for some of the fraud that you see in the space. So the cool thing about proxy pics is it'll have a GPS on exactly where the person was standing when they took the photo, and then they'll timestamp the photos. So if it was taken last year, obviously that might not be the current condition, but if it was taken last week, you're probably good. So this is where the borrower would pick virtual or traditional photos. We also care about how you're going to get through the project. So we get a lot of, and this varies greatly by market. So for example, in the state of Texas, you can be unlicensed and build a $4 million home with no general contractor and sell it to the public. And you can do that 50 times in a year. And there's no regulation behind that activity. And it's totally legal. Okay. Now, if you try to do that in Florida, that's a big problem. So in Florida, you have to have a licensed general contractor pull all your permits. The only way to get around that is if you plan on living in the property, which is an owner occupancy exemption. But as I said earlier in the call, we don't lend to owner occupants. That's a consumer loan. So if you're going to live in the property, you can't tell the building department you're going to live in the property and then it's owner occupied to get around paying a contractor, but then tell us that it's a business purpose loan and you're just going to do a permit yourself. So, and a lot of these depend on the market you're in. And really, the good borrowers and the good brokers and even good loan originators will tell us, hey, this is how it works in this suburb of South Carolina. This is how it works in, Atlanta, Georgia. This is how it works in Ohio. But the rules are a little bit different in each region. They vary by market. But nonetheless, we care about how you're going to get to the finish line. Now, if you're just painting the house, replacing the flooring, ripping out the kitchen, not a big deal, right? But if you're, repairing trusses, busting out load-bearing walls, doing all that kind of stuff, then we're going to want to see more qualified people overseeing those projects. So this is where we try to learn about who's actually managing that project. We have three ranges, low, mid, and high end. Let's just say this is a low end rehab and vacant property. And let's say it's a 3-2 and it's staying a 3-2. This is the other thing that frustrated me about the industry. So I've bought all these softwares, but no one has actually been able to put their scope of work in Flow. So I actually built this where you can put your scope of work in the same process, right? We're not uploading and downloading all these spreadsheets and all these different formats and losing them. And like, it's just complete chaos, especially when you're processing a couple hundred loans. So if you have a scope of work, you can upload it here in this document container. But we also have all these sections that you can fill out. So let's just say that this was a light rehab. It's just paint and cabinets, right? You don't need a permit for that. But let's say you had to take out the old kitchen, right? And let's say you're doing exterior paint. Maybe, no, let's just say repairing the garage door. All right. Major systems. I'm like spending way too much time on a fake scenario, let's see, all new HVAC. Interior, let's say $1,200 for drywall. Let's say insulation's good. Say $5,000 for trim. $4,000 for paint, $6,000 for flooring, LVP. Let's see, $8,500 for cabinets and countertops, and then $2,500 for appliances. All right, and then we'll do a final cleaning. $1,000 here. So you see how easy that is? Oops, let me go back. I forgot something very important. So that is the contingency. So we allow up to 10% contingency at central lending. And we have this little slider bar. We would like you to be able to do 5% and still have the project be profitable, but we allow up to 10%. And the newer a home is and the more predictable your rehab is, the lower your contingency can be. But if you're buying a old, if you're buying a house that's more than 50 years old, we really want to see that contingency maxed out. Or if the scope of work is just complicated, right? We need to know the title company, the insurance company. Let's see. I'm just gonna add myself. Okay. We have one of the coolest things we've done, guys, is we've connected with Plaid. So Plaid will go through their Plaid gives us identity verification. So a borrower can click on the identity verification. And let me see. I don't think I'm going to do it on a live stream just for security reasons. But just trust me when I tell you it's really cool. The borrower basically has to do like a selfie and take a picture of their driver's license, and then Plaid will scan their internal database, and then they'll look at the IP address of where all this stuff was done and share that with us and give us a risk score. Like, is this the real person? And then I'm sure there's a ton of secret sauce that I don't even know about, right? That's just our login on Plaid's side. And the other cool thing is now that we've connected to Plaid, we can bolt on the asset balances. So about 2 or 3 times a month, we get a fake bank statement, which is a real concern in this industry. So rather than, the processing team being on eggshells, essentially, every time they look at a bank statement, wondering, like, is this thing fake? Just make the borrower connect to Plaid, and then the asset balance is live. So pretty cool. So that's the guarantor. Then we want to figure out who the borrowing entity is. And then that's it. That's a loan. That's all you do. Then we have document upload. We've got the terms here. We've got our loan members. So that's how you submit a loan to us. Remember, that was fix and flip. Ground up is basically the same because there's a construction element. It's just that purchase price is typically way lesser. And we want to see a little more profit on ground up. Bridge looks a little different because there's no construction, but if the property's rented, then we want those rental economics. And then the last thing I'll show you guys is these DSCR loans. And I'm not going to go through a whole application. I just want to show you guys kind of the sizer. So let's just say $500,000 purchase. Let's say the rents are $4,000. Taxes are $3,000. Insurance is $3,000. HOA is $0. Let's say they own 2 rentals, no fix and flips, good credit. So look at these. So you see how on the last sizer, it was showing origination fee, loan amount, monthly payment, total loan. So there's a lot more detail on our DSCR sizer. Because borrowers who are buying a DSCR loan, they want to know what's the rent, what's the monthly payment, what's my cash flow, and then what's my DSCR ratio. So these are really important ratios when it comes to a DSCR loan. These are really important numbers. And you can see these rates are pretty impressive. And now at Central Lending, what we do is we will fund these loans, but we don't intend to hold them on our balance sheet, right? If we paid our investors 6.7%, they would not be very excited about us. But so what we do is we fund these, but we already know who we're going to sell these loans to before we fund them. And typically speaking, depending on the quality of the loan relative to the coupon rate, we can typically sell these loans at a premium. And we try to shoot for a premium of a couple percent on each deal. And it just kind of changes based on the market. But our strategy on the short-term lending side is to balance sheet, about 25 to 50% of the loans. Well, on this side of the business, we don't balance sheet any of these loans. So all of these, we know exactly who we're selling it to after closing. But just wanted to show you guys kind of how these work. And then I won't bore you with the details, but the only thing that changes on these, the only thing that changes on a DSCR loan and on a bridge loan with no construction is we replace that rehab budget area with this rent economics component. So we want to know if it's a long-term rental or a short-term vacation rental, because short-term and vacation rental economics are usually higher, but they're less reliable. So it just changes the underwriting a little bit. Typically, you can't count 100% of short-term rental income. And then you also want, typically you want a year of performance for seasonality and those types of things. So, but in any case, we just need to know what type of rental it is, right? Because it's a different process for us. And then, of course, we want your operating expenses that feed into your DSCR calculation. So those are that's kind of a summary. I think I'm up on my hour. Just wanted to kind of go through the state of the market, where we're at, kind of went through a couple live deals, showed the software, and I think you'll see some pretty cool stuff from us second half of the year. By the way, if you originate loans professionally, we can actually make you the lender in our software. So we can be your capital partner, but you can maintain that lending relationship with your client. So we're happy to accommodate third-party originators who give us plenty of volume. Anyone that you add, any client that you add underneath you, anytime they do a future deal, it automatically will add you to that deal. So that's what I was saying earlier. It's just very important if you're a broker, an account executive, even a third-party originator, please add your borrowers in, understand the software, because the residual income of them coming back and you getting more deals out of it and us getting more fundings out of it is phenomenal. So anyway, if you have any questions, you guys know where to find me. Thank you, Maxine. Good seeing you. Good seeing everyone on here. And I think in 2 weeks, Heather will be back. And in a month, I'll be back again. So I will see everyone in a month. All right. Thank you very much. Thank you very much. All right. Bye now.